So how did we get here? When David and I sat down and thought about what we wanted to do for this project, we were both keen to do something China-related, given A, its importance to the global economy, but also the fact that we were living and working in Hong Kong. And you might recall towards the beginning of last year, there was a lot of concern in the marketplace about debt in China. And so we figured we'd take it on with the hope of at least trying to understand what was happening and perhaps at least test some of what seemed to be a consensus claim out there regarding the inevitable collapse in China and China debt. What we decided to do, or how we decided to tackle this, was first to have a look back at previous banking crises throughout the world and try to understand the anatomy of these events and to see if we could extrapolate any of these learnings into the situation in China today. So when we hear banking crises, debt crises, what exactly are we referring to? Well, to steal the World Bank's definition, a banking crisis is a situation where an economy faces large-scale financial and corporate distress within a short period. But they are very frequent and they were very diverse. They're all very different. They're brought on for different reasons, different triggers. But the one factor which we found which occurred throughout all of them was an unusually strong accumulation of debt. There are other things, unsustainably high economic growth for a period of time, asset bubbles, and other sorts of financial imbalances, but it really is this strong and rapid accumulation of debt which was the recurring theme. So with that in mind, why is China in focus? As this chart demonstrates, post the financial crisis, you saw a very large and quick ascent or increase in the non-financial debt of China as a proportion of its GDP. And if you look at how this is broken down, and sorry if this chart isn't overly clear, but it's the corporate sector which was largely responsible for this rise. And what this analysis found is that as an indicator, China is now 3 times over the threshold that it uses as an early warning indicator for banking distress or some form of disruption. We did, however, find 2 examples which we thought are worth just dwelling on before we move into the analysis we've done. And the first one was, of course, China's previous NPL cycle. It actually wasn't that long ago. So in the late 90s and early 2000s, NPLs in China, and this is official statistics which we drew from the World Bank, peaked at around 30%. The next event which we'd flag, we found the parallels between the 2 experiences to be remarkably similar, and that is Japan. So if you think about where we came from, so think of an economy largely agrarian, not very developed. It then transforms itself, and it does this by implementing policies of financial repression, taking these savings, channeling them into investment in the economy, mainly through government-led financing, SOEs. It also has this parallel with a very strong manufacturing strategy, and you then become the world's leader in manufactured goods, steel production, so on and so forth. It sounds a lot like China, but before China is actually Japan. Now, what we found as well, the parallels in the growth models for these countries were equally apparent in the banking system. So if you look back at Japan, what we saw was growth starting to slow, but the banks continuing to lend and lend aggressively. Before I hand on to Dave, just to take you through some of the analysis, I think the 2 big things we took away from looking at the Japan case was, firstly, it is possible to have a banking crisis even if you have very high domestic savings and limited external vulnerabilities. And the second point, I think, is what I mentioned earlier. When you have your financial markets developing rapidly and with big scale, it's really important for your institutions and regulations to at least keep up with it, hopefully be in front. Japan obviously didn't do this. And the risk for China is that perhaps it's going to run into the same problems with its regulatory stance.
We did bottom-up analysis. We did a VAR. We did a lot of different credit risks on the equity market, and probably the most interesting analysis we did was Altman's Zed Score, which we were lucky enough through the program to spend a lot of time with Professor Altman when we were in New York. And if any of you are on Bloomberg and you look up a US company, you can see what's called a Zed Score for that company. Now, in 40 years in the US, this has never been beaten in terms of a predictability for bankruptcy. So we went, and with Professor Altman's help, we rebuilt that for China. Now, effectively, what our analysis came out with was the NPLs in China would peak out around 10.5 trillion renminbi. That to us was encouraging, but one point I wanted to highlight on that is, and this is a lot of follow-up analysis my brother and I have done, I've actually recently done another report on this, is a lot of the vulnerabilities we see, and if China's actually going to find a financial shock, it's actually going to be in the shadow banking industry, not the corporate book. So what we did in our note as well is what we want to, and what I want to mainly focus on now is policy recommendations, because as I said before, the size of China's potential NPLs right now are quite manageable. But policy at this juncture is critically important in terms of where we go from here. But against that, the point that I'd make is consumption growth in China is getting driven by income growth. The problem that I have with income growth in China is when we have corporate debt at 157% of GDP and corporate profitability anemic, I don't think that corporates can continue to maintain this double-digit growth in income that we've had every year for the last 7 years. Consumption really is driven by urban at the moment, not rural. And so we have this predicament at the moment where urban wages are about 4 times rural. The other thing in China, we have a very high savings ratio, and the reason for that is twofold. Obviously, a very underdeveloped private healthcare system and a very underdeveloped pension system. So unless we can see policy shift away from dealing with short-term economic issues and fiscal funding, debt-funded fiscal policy, towards dealing with some of these structural reforms to promote consumption, we could be heading into 2020 with a lot more elevated debt and quite a severe slowdown in growth driven by consumption as well. The other points we wanted to make was on the credit allocation process. Now, through our analysis, as we said, we spent a lot of time on SOE versus non-SOE debt. So in total, since 2008, SOEs have monopolised about 70% of China bank lending. Now, the problem that has from an economic perspective is SOEs are less than 20% of the size economy. So we've had this massive misallocation of capital over the last 8 years, which needs to be addressed going forward. The other thing we'd add on that is with capital market reform is the problem with the growth of the banking system as well is it dwarfs the asset markets. So China has an incredibly large banking system and it has an incredibly underdeveloped equity market. So the equity market is only about 4% of corporate funding in China. Now, the bond market is big, but it's incredibly illiquid. So it's actually the world's second largest bond market, but it only trades a tenth of the value of the US bond market. The developments in shadow financing are very problematic at the moment. Now, Adam's points on China's debt accumulation are pertinent, but one thing I would say to you, it's not the size of China's debt that by itself is the problem. It's the way that the banks are funding it. It gets back to the slide that we said earlier where the IMF actually estimated that 19 trillion renminbi of shadow financing assets within the banking system are at risk of defaulting, which is double what Adam and I forecasted for corporate NPLs.